this word of mouth publicity is the most powerful endorsement which mutual fund industry has for SIP.
I'll ask you a very simple follow-up question. Is SIP only meant for equity investors?
One can do SIP in debt investment also, but in debt investments the interest rate cycles are fairly long. You don't move from rising interest rates to falling interest rates in a quarter. It happens over probably 3 to 5 years. So yes, you need to do SIP in fixed income, but that's more from asset allocation point of view. When you get 100 rupee, it doesn't mean that you put all 100 rupee in equity. You need to have asset allocation between real estate, fixed income, equity, commodity, and so on and so forth. So one can do SIP in debt, but the benefit of SIP in equity is far more.
Mutual fund managers have often told me that maximum inflows into equities, they always come when market is nearing a peak or when market is stopping the cycle. And we currently know that inflows into equities from Indian savers have started. So purely looking at historical market behavior, is the SIP boom an indication of a bubble or a market top?
So let's first look at from a market point of view, and then we will look at from an investor point of view. So in 2008, when we could see the last bubble of the market being created, market cap to GDP was 146%. Today it is roughly 90%. So certainly on a market cap to GDP basis, we are not expensive. The second thing is the corporate profit as a percentage of GDP then was about 7%. Today it is about 3.5%. So we are having higher valuation with lower profitability, and there is potential that this profitability can start moving up. So today it is fair to assume that we are not in a bubble like in 2008. It doesn't mean that there won't be a correction tomorrow. Of course there can be a correction, but it won't be as sharp and as deep as it was in 2008. Now let's look at from an investor point of view. We haven't yet seen a panwala or a taxi man talking about investment in equity.
But they're talking about SIP now.
They are talking about SIP, but that's in a positive format because these people are now investing for a longer term. Earlier SIPs used to be 12 months, 18 months, 24 months. Now we are seeing regular SIPs at 5 years and 10 years. The other thing which is happening in retail investment is that they are not going towards euphoria kind of thing. Of course, there are few penny stocks where valuations have run up way ahead of its fundamental, and it reminds me of Harshad Mehta or Ketan Parekh days. But certainly that's very small percentage of market. It's not a large percentage of market. And my feeling is that yes, in penny stocks there could be euphoria and bubble, but rest of the market, it's fairly valued. It's not cheap anymore. And hence you need to invest in via systematic investment basis for a longer term.
What is a good age to start SIP?
I mean, the day you get maturity to sign a check for SIP is the best day to start. SIP makes sense for a 18-year-old kid. It makes sense for a 81-year-old gentleman also, provided they have the time horizon for investment. An 81-year-old gentleman who is looking to bequeath his wealth to the next generation has no option but to do SIP in equity. An 18-year-old kid also has no option but to invest in equity if he wants to have the financial independence or financial security.
Every 5 to 7 years we see that there is a crisis somewhere. And when crises come out in the open, equity markets, they give you a negative return of 50 to 70%. The challenge has been that a lot of investors have burned their fingers in the past. And the recent example here is what happened to portfolios in 2008. So that's always this big hesitation before you commit money to equity. Either you want instant gratification or the past is haunting you.
So undoubtedly investors will have to overcome that fear. It's like bungee jumping. You just have to jump knowing fully well that there is a code which will protect you. Now either you can not do the bungee jumping and lose the experience, or you can take the plunge and enjoy the experience. Equity market is volatile. Here there is no guarantee. Best of the stocks, best of the market, best of the fund managers will go through that volatile phase. and which is why SIP makes sense. If you keep on investing on a regular basis for a longer period of time, you will eventually see the benefits coming into you. If you bisect data of last 25 years, this proves that point. And my feeling is that over next 25 years also, the same tendency will be reflected. But there is no substitute to volatility. Equity is risk, and hence it is giving better return. In fact, someone made a nice point that suppose if we take out volatility from equity market, because it's giving 15% return, and if you take out volatility, so much of money will come that the average return for investors will probably become like fixed income 6-7%. So it is because of the volatility the return is higher. You take out the volatility, return will drop.
You take a high risk and the return
Absolutely.
is going to be rewarded disproportionately. That's how financial assets they move. So my next question to you is, SIP may sound like a very simple process. You invest every month. Don't count months, look at years, and analyze your portfolio every 3 to 6 months. But currently, the option to pick and choose also is getting rather complicated. There are 30 or 35 AMCs. All schemes on an average have about 5 to 15 schemes, which pretty much offer the same proposition that if you're a long-term investor, come and invest. An average investor or saver has to pick and choose between 1 to a maximum 3 schemes. How does one zero on the best scheme?
So my job is to say, please pick up Kotak mutual fund schemes, but that's in a lighter vein. On a serious note.
On a serious note also, why should one pick up Kotak then? What is that you are offering as house which is different?
So we are the only mutual fund house today in the top 10 who is believing that mutual fund schemes are like their kids and we should not manage more than what we can afford. So we have taken conscious decision to keep just one large cap scheme in large cap category, unlike many of my peers who have diversified large cap, concentrated large cap, value focused large cap, growth focused large cap biased large cap, mid cap biased
it's
large
very
cap,
complicated.
Dynamic large cap, non-dynamic large cap. When if you have so much of confusion, investors are going to get confused, and which is why they need the help of an advisor who can choose out of 500 odd schemes what is more appropriate for the customer. Don't go by the size, don't go by the past track record, go by the current portfolio and the current investment process. Investment process is very, very critical, current portfolio is very, very critical, and which is why if you don't have time and ability to analyze that, please go and pick up the services of an advisor. That will pay you well.
But Nilesh, what we've seen is that just like all asset classes, they follow a cycle. Fund managers also follow a cycle. There are some fund managers who had a 3 or 4 year of great track record, but the next 4 or 5 years they even underperform and they don't even beat the index. How does one choose the best scheme and the best fund manager? I mean, my question to you is very straightforward.
Like in cricket, Tendulkar will get out at 0 someday, but that doesn't diminish his reputation as the best cricketer of the world. A fund manager is going to have a bad day, but one must appreciate that form is temporary and class is permanent. What's the thinking of the fund manager? What's his investment process? How has he behaved in the past during the upturns and the downturns? If a fund manager was 100% invested in Jan 2018 equity and was having 40% cash in October 2008, then certainly he is not the best fund manager. On the other hand, if he was on the reverse side, then even with the underperformance in 2007 or outperformance in 2008, he is the best fund manager.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.